These sold opens are getting to be a habit.
Yes.
How long can this go on?
Well, we stopped at the initial resistance in the S&P around 1901 to 1905. So we have a minor double top today, and as Pisani alluded to, a rather extensive triple bottom. So we're working between the technicals here.
Mike, you have a list this morning on .com. 4 things that might give us something more than a short-term bounce.
Yeah, I mean, trying to get at this question of, I mean, in addition to all the kind of negative headlines and the real selling intensity that's been coming from, around the world, I feel like there's been a real lack of motivation for buyers to step in right here. I think a lot of professional investors came into this year expecting not very much, felt like there wasn't much of a hurry to really get aggressive. So 4 things. I mean, obviously earnings are here. It's tough to handicap whether we've kind of priced in a really wretched earnings season or not. The revisions, the estimates don't seem to have come down enough. But obviously, if you beat by 3 percentage points a quarter, if that holds, maybe that's at least on a spotty basis a net positive. And then that actually clears the way for companies to come back and buy back stock. They're mostly in blackout mode. Again, I don't think they're going to be as aggressive as they have been in past years, just because their credit markets aren't as generous. They're not getting rewarded as much as they have been in the past. Buyback stocks, if you look at the ETF, like a PKW, badly underperformed recently. So maybe that's no longer the magic.
Art, if you want to be a buyer here, if you've been preserving your capital, you're waiting for a catalyst, what is that catalyst? We now have earnings that were as uneventful as we expected. We get a jobs number in a couple weeks, G20 central bankers meeting in the middle of February. What would you wait for?
Well, just as Mike alluded to, a lot of companies are in a blackout period relative to buybacks. So as earnings season winds down, I might start nibbling right there, assuming the corporations are going to come in right behind me.
Although, I mean, Costin of Goldman has already said they're the only source of marginal demand. Yeah. If Mike's right, and they're not as going to be as, although Delta is out this morning saying that they're still leaning with a bias toward using fuel savings for buybacks. Question is if that's the norm or not.
I think, though, even if it's down year over year, it's not going to be 450 billion. Maybe it's going to be 400 billion. I mean, it's still going to be a relatively steady bid unless really the credit markets do get very, very ornery.
We had a little negative news from Intel last week, particularly around enterprise buying, and of course we knew emerging markets were sort of a mess. But now we're starting to get some of the growth companies that are reporting. Netflix, eventually we'll get Amazon. How important is that growth story to the overall market sentiment? If the subscriber numbers internationally look good for Netflix, for example, might that give people hope?
Well, I think they'll get some, but I think in particular they'll look for guidance. How firm is the guidance? How optimistic is the guidance? And that's what they'll play off, I believe.
I mean, I do think that if you're a fund manager, you desperately want to be able to focus on things like these company-specific metrics. You want to get an escape from this macro-driven kind of crude oil-led and policy-led moves. I don't know if it's going to get clearance for that or not, but I do think if that becomes the story, it's probably a net positive. You're going to at least make the case. Merrill Lynch is out saying that the stock market is pricing in a 50% recession possibility, whereas the Treasury market's maybe like more like 25%. Can't say that with any precision, but if you start to get the economic surprise indicators little bit less negative, then it's going to give people an excuse to go looking for some of those individual companies to buy.
Art, there was a question on Squawk Box this morning, though. Could we talk ourselves into a recession? Could the rhetoric become so negative that we're there before perhaps some of the indicators would have led us there themselves?
The economy is run by psychology, and you could actually do that. The corporations start to pull back and say, I don't want to advance anything. I don't want to hire anybody. We could slide right into a recession. And you're at a relatively weak point. And again, oil is ruling the market. So if WTI breaks 29, there's going to be pressure back on the market. So the first thing you want to hope is that this rally doesn't fade. If we go negative or if it all disappears, we're going to get that negative tone back in the market.
It seems like, I mean, maybe, I don't know if you agree, Art, but last Thursday is kind of hanging over this market, too. You had this strong-looking 2% rally, and it was gone by Friday morning. So I wonder if that's giving people a little bit of hesitancy to really participate.
Bottoms tend not to happen on a Friday. Is that true, Art?
Absolutely correct.
We're going to see what Tuesday brings. Gentlemen, thank you very much. Mike Santoli and Art Cashin.